Okay, folks. So tonight's call, I'm gonna talk about why smart property investors won't wait until 2026. Quite often, when things happen with property, and I've been in property and real estate for well over 25 years now or more, and I often see people sit there and wonder and wondering, oh, when should I buy? When's the right time? What's the market going to do? Is it going to crash? Is interest rates going to go down? Oh, will the property market go up? And by the time people sit there and second guess whether it's 3 months or 6 months or whatever it might be, prices have already moved. I can share with you right now because I'm on the ground floor. I'm doing this day in, day out. I've been running my business now, TonyHarringtonCo.com, for almost 15 years, and I've been property investing for over 25. And I see it continually. People, by the time you see something hit the media about what's going on with property and property price growth and where the capital growth is, I can tell you you're already 3 months to 6 months behind the curveball because when it hits the news, they get all their data from CoreLogic, which is now called Cotality. And CoreLogic data really reflects, 3 months behind the science scenes. So it's not really a true reflection. And also, it's very broad. It's across the board. It's Australia wide. It doesn't really go into micro. It's a pretty macro assumption. And therefore, what do most punters do? They sit at home, they watch the news, they read the papers, and that's where you get most of your data and intel. So today, I'm going to share a few things that really opens this up for you, shows you what's actually happening in the market, why property is going to fly, and I'm also going to give you a couple of areas or a couple of regions that I think are going to absolutely take off big time. Well, they're already doing it, so I'll pinpoint a couple of areas for you to maybe have a look at. If you want some specific advice about what to buy, where to buy, and how to go about doing it, again, you can contact me direct, TonyHarringtonCo.com. But for now, let's get into it, huh? Hang on one tick. All right. Well, listen, here's what's happening. The RBA last week at their at their October meeting, they held interest rates and kept them on pause. Now, the sentiment was 2 or 3 months ago that we'd probably get two or three interest rate cuts before the end of the year. Well, how quickly does things change? Because um, they did give us one cut of 0.25% interest rate cut. However, we're not going to get the two or three cuts by the end of the year that all these economists were absolutely predicting. And while I'm on the topic of economists, I don't pay much attention to those guys because most of the stuff that they predict usually goes wrong. And COVID was a perfect example when they said property prices were going to drop by around 50%. And fact is, property prices doubled, tripled, and quadrupled in most regions right around Australia. So I don't give these people too much credit. However, here's what else is happening. There's a first home buyer's guarantee, and this is going to create a really rare window for property investors. And before I delve into that, let me take you back to the early 2010, 2011, 2012, when I know definitely in Victoria, the Victorian government, and I think it was around about, they introduced the first homeowners grant. So for people trying to get into the market, this isn't the first time governments have tried to encourage first time buyers to get in and buy and help them buy. But back then it was about a $30,000 first homeowners grant, right? And I think there were stamp duty concessions and whatnot. So what we decided to do in my business as property investment advisors, we sat and looked at it and thought, righto, then if there's $30,000 on the table, first home buyers are going to hit the market. Where are they going to buy? What are they going to buy? Well, it wasn't hard to work out house and land because they're mainly young people, they're families, young up and coming families. They want to live in a nice house. They want to have a little bit of lawn, a little bit of acreage to have a bit of fun on with the family and the kids. So we started parking all our clients, investor clients, in and around some of the best estates and the best locations that we could find. And before you knew it, prices just went through the roof. So I'm going to explain to you here why this first home buyer's guarantee and a couple of other pinpointing reasons are really going to set a rocket under the property market right now. And those that get in early and act fast are the ones who are going to get the best uplift and the best capital gains. Those who sit on the sidelines and just wait and watch, you're going to miss the real curve when it comes to property investing. So let's get into it. Here's what happened last week. The RBA kept rates steady. Now, most of the expert commentary out there now is that we probably won't see any rate cuts until 2026. I'm not an economist and I never would pretend to be. However, I do know that in the US, they're probably going to cut rates next month and they're probably going to cut rates over there the month after. Now, whether that causes a flow-on effect into the financial markets and into the banking system or what, I don't know. However, keep your eyes on that because I know that's predominantly where the USA is going to head. Usually when the US sniffs, everybody else sneezes, everybody else gets a cold, right? So what happens there then? Okay, if we see that there's going to be no change until early 2026, that just gives investors a little bit of clarity and a little bit of confidence that, well, okay, they're not going to go up and they're not going to go down. Presumably, if they do anything in time, whether it's February next year, March next year, whatever, again, we're sort of looking at, interest rates that'll probably go down. So if you're thinking about it as an investor with an investor hat on and from a cash flow perspective, chances are there's going to be a bit of a calm before the storm. There's going to be a bit of a calm before the surge. But I can tell you right now that I know major property groups and business associates of mine who operate out of Perth and who operate out of Brisbane, and there's a few of them that I know. They're all honing in on Melbourne. They're all sending their investor buyers agents into Melbourne. They're looking for deals in Melbourne, and I'll show you why Melbourne's going to be such a go-to place. Having said that, though, every capital city in the country has had an increase in capital growth for the last 3 months ongoing. That's every capital city in the country, right? So what happens when interest rates finally drop? Well, then here's what's going to happen. It's going to create more buyer competition. So because there's going to be more buyers in the market. So a lot of people have sat on their hands for the last 12 months or even more, waiting to see what's going to happen. And now we're going to have this massive influx of first home buyers. We're going to have investors. We're also going to have immigration's a big one, right? There was something like 1.8 million immigrants come into this country in the last 2 years. We've got a major shortage supply. We've got builders that are dropping projects left, right, and centre. I know Hutchison's dropped $7 billion worth of projects off their books around about 12 to 18 months ago. Material costs are going through the roof. Building costs are going up by around 30-40% in most cases. And they just can't get tradies to fill the bill. So no matter what the bullshit government says to you in regard to 1.2 million houses in the next 5 years, I mean, that's a furphy that you probably hear down at the local pub, right? So I wouldn't pay too much attention. And listen, this is just a bit off the cuff, but I think they're two of the biggest bullshit artists I've ever watched, is that Albanese and Slim Jim Chalmers. But anyway, that's another topic. Let's keep rolling. All right, here's a real game changer. It's the First Homeowners Guarantee Scheme. So they can now buy a property with 5% deposit. This is just my personal opinion. I think it's good for some people, but I think that when the markets change or when the finances start to shift and interest rates start to go up, I think a lot of people could get caught out in this scheme. And in my experience of, over 20 plus, 25 years in the property game and over 45 years in the building industry myself personally, every time I've seen a government scheme involving housing hit the pavement, it usually hasn't ended up too good, right? So again, I'll just say buyer beware. First home buyers, I think if you can't get together at least a 10% deposit, chances are you probably shouldn't be buying. But the thing also with the 5% deposit, they still have to fit the bank's criteria for serviceability and lending, right? So the banks just aren't going to lend money willy-nilly. But here's the next problem some of these first homeowners may face over the next couple of years is that if it ever gets to the point that interest rates go up again and they can't afford to pay for their properties, then the banks are going to say, well, hang on, we want our money back. The purchaser is going to have to stump up the other 15%, right? Because at the moment, the government's going to do it. So there's a bit to it. So if you're a first home buyer and you haven't listened to this, go and do your homework, do your research, do your due diligence, and go and talk to your finance broker and make sure you're getting the right advice, okay? Pretty critical. There'll be no lender's mortgage insurance. So what that means is that if you borrow more than 80% of the price of a property, banks will lend you 80% with no lender's mortgage insurance. But once you go over 80%, they charge what's called LMI, lender's mortgage insurance. So With a 5% deposit, that means you're at a 95% LMI. Now, this is where the government steps in and sort of creates this buffer that there's no LMI involved, and that's what's going to make it affordable for people to do. Again, am I a fan of it? No, I'm not. However, this is government and this is where it's at, so I'm just pointing out the obvious here. This is going to open up doors to those who couldn't afford repayments, who could afford repayments, but didn't have the deposit saved. And it's a government-backed confidence boost. Well, fair enough, but again, I'll keep my opinions to myself, actually. So here's what we're going to say. What's going to happen to property prices when 10,000 new buyers join the race? You think about it. Right now, I'm seeing auctions. Properties are being sold really quickly. I'm also seeing rental properties now where 40, 50, 60, 70, 80 people are turning up and open for inspections for rentals. So there's a lot playing out here. So I really don't know whether whether the government's really sat back and had a look at this. And I'm going to show you something at the end of this presentation here about it's already hit the headlines today. Now, I don't know how true it is, but I seriously believe that this is going to put a rocket up prices, and the demand is going to completely outstrip supply, and there is no way known supply can catch up in the next 2 years or 3 years, in my view. And therefore, that just points to one thing: less supply, more demand, prices have to go up. Now, here's a little thing that I've seen just a minute ago. House prices up 100,000 overnight. So I don't know if this is 100% right yet, but someone's already claiming that housing prices have gone 100 overnight. Well, if they have, I hope they've gone up in areas where I own real estate. But these are the sort of headlines you're going to expect to see. Now, I don't know whether this is true or whether it's not. I doubt whether it is. However, just be aware that this is where it's going to head, right? So why does this matter for investors? Well, rate cuts, they're going to have a gradual impact. It'll give people more confidence, and people will be able to sort of forge ahead, and more people can get into the market. The first home owner scheme, okay, that's just going to create instant demand and instant surge. And investors acting now, buying before emotion, first home buyers flood in, you're going to be able to get in at a price point before that flood comes, and they start pushing these prices up. The other thing that happens when we've got a market like this, when there's such a big thing to play out, the developers are aware of this, right? So they know that land's going to be at a premium. They know they're going to punch up their land prices. Builders know that to build now, we're going to have to build at a premium. So builders are going to punch up their build prices. And the market is the market. Again, I'll keep going back to supply and demand. It's one of the simplest fundamentals that you'll ever come across when it comes to property and real estate. And supply is going to be 100% outstripped by demand. Waiting now means you can pay another 10 or 15% more in a year. So if you think about that, think about, say, an $800,000 property today. If it goes up by 10 or 15% more within a year, you're going to be paying closer to 900,000. I mean, that's close to 100,000. It reminds me of a client of mine who, when this particular client first heard me speak on a building site, he was keen, he wanted to invest, he chose not to, and that's fine. But he came to me 6 years later and said, "Hey, Tony, I think I should get in. I think I should do something." I got him a cracking deal, right? But the point being, he missed out on 6 years of growth. He missed out on 6 years of tax deductions. He missed out on 6 years of knocking his house off faster, paying off his mortgage quicker. I mean, the cost we worked out was close to 350 grand, just because he sat and waited for 4 years after 6 years, right? So sitting on the sidelines, watching the world go by, you're going to actually lose money sitting there doing nothing. So let's have a look at some current median house prices in Australia right now. Sydney's at about 1.55 million. Melbourne's at 950,000. Brisbane's at 1,062,000, right? So Brisbane is now higher price medium than Melbourne. So Adelaide, Perth, Hobart, Canberra, Darwin, they're not as significant markets, but the big three, Sydney, Melbourne and Brisbane. And as I said to you, I've got property investor clients and business associates of mine in Perth, and they're bringing all their investor clients to Melbourne. I've got two of my big company mates over there have bringing all their buyers to Melbourne. Brisbane Property Markets is now targeting Melbourne, etc. So there's only one way I think that this can go if that's the case, because you've got an influx of first home buyers, you've got an influx of investors, you've got an influx of immigrants that have come into the country. And my question is this: where are they all going to live, right? We can't build fast enough, we can't get tradies. So there's a real dynamic that's playing out, and it's going to be a whirlwind for investors who get on board and get on path. So here's where we're at. The Melbourne house prices are forecast to rise to around about 1.11 mil by financial year 2026. Now, that's a generic, right? There's going to be areas that are going to do a lot better, going to do a lot more, going to do a lot faster than what, the overall medium states. Vacancy rates are ultra low, so rental demand's climbing. We're investing in an area right now with my clients, and we've got a 0.5% vacancy rate for rentals. So what does that mean? That means that there's supply versus demand. There's just no properties out there, and we're seeing 30, 40 and 50 people turning up at open houses for rental properties, right? So the rental market's going to keep moving as well. There's a construction slowdown. There's limited new housing being built. Even connections are mine in the big commercial space. Same story there. It's slowed right down because a lot of the big builder developers, they've had to pull back on these big apartment projects that they ran feasibilities and did the numbers on 4 or 5 years ago, because the markets have changed so much, with interest rates, with construction costs, with not being able to get tradies. And a lot of these big projects are being shelved, and they're actually getting revamped. They're going to get repriced, and they're going to be coming in at newer prices. And for clients of mine who bought boutique investment apartments about 7, 8, 9 years ago, which we did, a few of us, now I'm going to see a real push in that space as well, anywhere from, say, 4Ks to 10Ks from a CBD. So we're going to see some good growth in units and apartments as well, right? So this is the real early growth phase, folks. So the reason for this call and this Q&A tonight is to just give you the heads up to say, look, if you're not in the game, you're going to sit there and lose money, and you're going to be kicking yourself a year from today, and you say, oh, geez, I wish I had have, I wish I should have, but I know I could have, right? So now's the time to do it. So rates are on hold, so we can predict what's coming up. Demand surge is coming in from the first homeowners grant and immigrants. There's early growth already visible. I've got areas right now where I've seen estates and stages being sold out in around about 2 weeks once they've hit the market. There's a short supply amplifying competition. So it brings me to sort of round this off and say, well, where should I buy? Well, let me give you a couple of generics, and these are things that I think you always should look at when you're going to invest in property. Number one, you should be looking at buying close to major infrastructure spending. So that might be where hospitals are getting built, where schools are getting built. It might be where train stations are coming in, transport modes, big infrastructure that's going to create jobs, employment. Where's population going? One of the little tricks that I learned years ago from one of my mentors was really simple. He said, hey, Tony, do you want to know where to buy real estate? I said, yeah, I'd love to. He said, well, all right, go and have a look. Where's Westfield building their next shopping centre? Where are McDonald's opening up? And where are Bunnings opening up? That might give you a bit of an indication that population's coming, people are coming, and they spend millions on that research and that data, right? As I said, transport, schools, shops. Look for centric circles and positioning. Now, what do I mean by a centric circle? So let me give you an example. A few years ago, well, actually it was back in mid-2000s, I bought a property in Richmond, which is a suburb in Melbourne, around about 3.5, 4Ks from the Melbourne CBD. The reason why I bought it is because all the suburbs around it were going sky high, and Richmond was sitting there like a little ugly duckling because it had a bit of an enigma to it for a few different reasons. But all the prices around it were going really, really high, and that location just sat there. There's an area that's doing the same thing in Melbourne where I've put a few investors in the last couple of years. We haven't seen the real kick yet, but it's coming shortly. And that was Footscray, which is 5 or 6 Ks from the Melbourne CBD, where all the areas around it, like Yarraville, Seddon, Williamstown, Newport, a lot of Maribyrnong, a lot of these areas were really high in price. But again, Footscray was one of those areas that just had that little bit of a enigma attached to it. However, the whole suburb's being gentrified. There are buildings getting built all over the place. There's shopping centres. There's hospitals that have just been built, 1.5 billion on the Footscray Hospital. So that's what I mean by centric circles. There's a tradie shortage, builders' costs are rising, there's a sinking supply. So this is the sweet spot for price acceleration and competition to heat up. Now, if the Melbourne price point's a little bit too high, where would you go? Well, we've got an area which is around 40 to 45 minutes from the Melbourne CBD. I've actually got a couple of them. Lower price points than Melbourne. Demand is coming through the roof, but one of the reasons we're investing in one of these areas is because there's an $11 billion suburb going to get built right beside where I'm putting investors right now. So if you've got $11 billion of infrastructure and money coming into a specific area, that's going to have a major effect on property and property prices. So if you want to know a few more details and you want to know where to buy, what to buy, and how to go about doing it, because I've put all the deals together and I've got the relationships with the project builders and the land developers to access this type of product, then get in touch with me and you can book a call with me at tonyharringtonco.com. So let's have a look. While we're waiting for cost cuts, while you're waiting for rate cuts, that can cost you thousands in missed gains. Early movers always secure the better properties and the better yields. Timing beats perfection. Property builds wealth over the long time. So I don't worry about timing a market, right? Because we're never going to get it 100% correctly. However, having said that, though, time in the market's where you're going to make all your money. And all my clients, I say, listen, this is a 10 to 15 year window. There's going to be a period of time where prices go up, a period of time when prices level out, and a period where prices may dip a touch, right? So you've got to be able to ride the cycles and hold for that 10 to 15 year period. So, okay. So what is it that holds most investors back from acting right now? I think it's twofold. I think one, it's fear. Two, it's trying to be too perfect. And three, you're listening to the media and you're reading the newspapers, right? Don't pay attention to the media because by the time you get there, they're way out of the market. They're months behind. So my question to you is this: would you rather buy now, before, or after the price surge? Choice is yours. There we go, folks. That's my little overview for tonight. I hope you got some info out of it. Listen, I can help you identify pretty good high growth opportunities before the market really heats up. So book your free property strategy call today. Just go to www.tonyharringtonco.com. That's tonyharringtonco.com. I don't see any questions in the comments tonight, so I think we're just going to wrap this one up. I'll wrap a replay of this up. I'll put it live online on my Facebook, and I'll also send the replay out to my database sometime tomorrow. So for now, hope you're going well. Hope life's treating you good. And I hope you're kicking goals with your money, your financing, your property, your investing, and your love life. So have a great day, and I'll talk to you next week.